Unfortunately, we see downside ahead. We still believe a recession is likely in the first part of next year, as a lot of these headwinds have a delayed impact, particularly around the corporate and household sector. Welcome to Key Points for November. Now, since we last met, of course, there's been these atrocities in the Middle East taking a massive toll in terms of human life. But from a macro and market perspective, what really matters is what does it mean for corporate earnings? And on that front, the news is fairly decent. The oil price is usually the reflector of that. And we've seen oil supply being maintained. And in fact, the price of oil is actually lower than it was back in September. But turning to the three key points for November going forward, our first one centres around the resilience of the US economy, why it's held up so well, but why we think there's downside ahead. We turn our attention to the bond markets, which we've seen surging government bond yields. What does that mean and what are the drivers behind that? And we turn our attention to the decline in equities. Now we're seeing the S&P 500 actually in correction territory. What does that mean and what is the outlook for the months ahead? Now, turning to our first point around the resilience of the US economy, it has been quite remarkable. We've seen retail sales hold up in terms of consumption. We're also seeing durable good orders coming in very well. And that's been really a characteristic across the course of this year so far. You can see in this chart here, what I'm showing you is economists' forecast for US GDP growth for 2023. And this time last year, everybody was cutting their numbers as it appeared recession was going to hit, as it appeared that the higher interest rate environment was going to be taking its toll. But since then, as I mentioned, the data have been pretty decent. And in fact, the forecasts now for the US economy for this year have moved back up quite appreciably again. And of course, we're seeing that in terms of a lot of, as I said, the consumption data coming through. Why is that? Well, partly, of course, it's because excess savings from the pandemic are still being worked down. We're also seeing the 30-year fixed rate mortgage in the United States, meaning that a lot of households have been immune to these higher interest rates. And in the corporate sector too, as we've mentioned before, companies have termed out and extended the duration of their loans at very low rates in the years gone by. And this is one of the key reasons why the economy has been so resilient. But unfortunately, we see downside ahead. We still believe a recession is likely in the first part of next year, as a lot of these headwinds have a delayed impact, particularly around the corporate and household sector. So still forecasting a recession, even though that the economic data currently is held up well and much better than, for example, in the Eurozone or in the UK, where again, the economic numbers are becoming in very disappointing of late at a time where interest rates remain very elevated. So turning to our second point, government bond yields have continued to push ever higher. You can see the chart I'm showing you here. This is the red line is UK gilt yields 10-year that have moved dramatically higher over the last year or so. And in the case of the United States, the blue line here, we've got up and actually breached 5% in recent days. So why is this? Well, part of it, of course, is because inflation remains sticky and it's not yet been vanquished, so investors are concerned about that. It's also because the central banks are talking in very hawkish terms, suggesting that we may get further rate hikes, even though we think we've seen a peak. And of course, it's also been a function of the demand side. In the case of the US, we've seen concerns around rising fiscal deficits. And when we look at overseas buyers, both the Chinese and Japanese, for example, have actually been reducing their holdings of US treasuries in recent years. So a combination of both supply and demand have kept these yields higher. That said, we actually think at these kind of levels we're reaching a peak. It's having a real impact on economic activity. And in real terms, adjusting for inflation, these numbers are still rising in real terms. As a result of that, we think that actually the nominal level of these yields is likely to gradually come down over the coming months as economic activity slows and inflation continues to grind lower. Now, turning to our final point, we think the downside in equities still remains. Markets have come off quite appreciably. You'll remember last month I mentioned the risk of this. We were looking at things like the small cap index in the United States, which had clearly rolled over. And if we look at the chart that I'm showing you now, you can see the S&P 500 and the bank index, the red line in the United States as well. You can see they had both had a very good correlation, both in the way up and way down. But you remember what happened here when we had the banking crisis or the banking problems back in the March period. The banking index fell. But what's notable here is you can see actually that it really hasn't recovered. It's actually lower than it was back in March and again in May. Now, what does this mean for the S&P 500? Well, it had been in quite a good uptrack over the bulk of this year, but you can see it's peaked out at a lower level, a lower high than it did last year. And now we're seeing a correction taking place. In other words, this is defined as a market falling more than 10% from its highs. That's what it's done. And we suspect while it might be looking a little bit oversold in the short term, meaning it could bounce a little bit, we think the direction of travel is still lower as economic activity continues to weaken, as margins continue to come under pressure, and we think that the outlook for earnings becomes more opaque. Now remember, as always, you can read the full report on our website, and please do keep the comments coming in regarding the videos. They're very much appreciated.